great future. We're talking real money.
Real money is really important, and that is a reality. We are all required to at least have a few financial skills. It's not optional. You have to understand money, and probably a whole lot better than you do, because most people don't understand it well. That's why we've got these two old guys on the radio every Saturday since the beginning of time, pontificating on the best ways to invest, save, spend, retire, that kind of stuff. I'm Don McDonald. Over there's Tom Cock. Our phone number is 855-935-TALK, 855-935-8255. And, looking at the phone lines right now, it's certainly not a light show. There's no fireworks going on.
I see. The lights are not
going
flashing.
on.
Okay,
Yeah, there's nothing. There's nothing. What do you mean? Me call? I'm on already.
No, you call, because I don't like the questions you asked.
You looked right at me and you said call.
No,
so I thought you were talking to me.
Call. And next week, program note, Don will be on his own, because I will be in Las Vegas celebrating my birthday. So call then, too.
Yeah, happy birthday or whatever.
Thank you.
But the fact of the matter is, you duck out on the show.
Sentimental guy.
You are always ducking out on the dang show.
Come on. When was the last time I wasn't on?
Vegas. He loves gambling more than he loves talking real money.
Taking my entire Roth IRA down there and putting it on black.
Oh, you're going for roulette this year.
Yeah, just hope it swings around right there, man. So
the blackjack just didn't work out for you like you'd hoped.
No, it's a thinking man's game. I don't do well there.
Yeah, really you can count cards
20,
as long
21? No, okay.
You can count cards as long as you memorize them. Yeah, good luck with that.
Mm-hmm.
Anyway, 855-935-TALK, 855-935-8255. Your questions are far more important than the silly drivel we want to talk about. So we hope you will call us, 855-935-8255. And, that's free. It's really easy. Just call us. Now, often you hear us talk about exchange-traded funds. And we have talked about how exchange-traded funds are a brilliant invention. But they're nothing new. I mean, we take so long to pick up on a new thing that we were telling you to be careful with ETFs for probably 15 years after they came out.
Yeah, maybe 15, but 15? A long time. Yeah.
Yeah, because we want to just make sure things work. But the one thing ETFs aren't is gimmicky. I mean, they shouldn't be. They don't need to be. ETFs are basically the mutual fund improved by some really brilliant thinking.
Yeah, and last year, can you believe this? 224 of them closed. They can't have been around that long, right? 224, which is the most since 2020.
Well, that's because of the gimmickry, I would guess.
Yeah, no, I mean, listen to some of the ones that left. Now, for those of you who are either Jim Cramer supporters or detractors and want to invest in an ETF based on whatever he says, can't do it anymore. It's over for both Long Jim and short.
Long Jim has been...
No, it's all shut down.
Been
axed. Yeah. Those of you who wanted to say, I love Jim, I want to invest like Jim. And short Jim.
Well, S Jim is still around.
It's going away as of February 13th.
Oh, S Jim's going too?
Yeah, sorry. Shorty.
You know what's funny is the one that did the best was for most of that time was the L Jim.
Yeah, but last year stocks went up. I mean, that's not saying a whole lot. I mean, I say the inverse lost 15%.
And just to let you know, the long Jim was they would go long, they would buy the stocks that Jim suggested, actually buy those stocks. And in the short Jim, they would sell short. They wouldn't buy them, they would borrow and sell the shares, hoping they go down. So they're making both of them go away. Maybe, well, could it be because they didn't ever raise much money?
Did you see how much short Jim had?
I'm looking for the number. I'd seen it before.
I can tell you. I know how much.
Oh, yeah, tell me, because I got to pull it up.
$2 million. Now, to those of you who know much about this industry,
that's a fraction of Tom's personal portfolio.
Barely. And I put $1 million of it in there because I wanted to really make some money. Now, that's not very much money for those of you playing along at home. That's not much. But how about some of these other ones that I didn't even know? Tune, Tune, music industry themed. No, probably should be shut down after a few months. Or Bad, not Michael Jackson Bad, but it was a Sin stock strategy. That's gone too. Meme is gone. I mean,
hold on, we'll have some more. I love these. These are cool. I want to guess what they are. 855-935-TALK is our phone number. 855-935-8255. Call now. It's as good a time as any.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
During the break, I wanted to find out. I was thinking about Slim Jim, S Jim, instead of Long Jim.
These
Long
are
Jim,
exchange-traded funds, yes.
The one that's lasted for a little while got to a whopping $2 million under management, $2 million, which at their current charged fee structure,
which is
1.2%, is a whopping $24,000 a year to the management group. $24,000 a year.
Hard to operate a fund well with that amount.
From the Tuttle Capital Management Company. Tuttle manages now 7 ETFs. It'll be 6 soon. And
they have the one. They have the one with the bet against Kathy Wood too.
Oh, do they?
SARK.
Oh, I have never looked
Shorting
up.
ARK.
Oh,
SARK. You want some more?
Is there a long ARK?
I don't know. Well, you buy ARK for the long ARK. Tune. We already talked about Tune. How about Gen Y?
Gen Y. That must be products that
they didn't know. The author didn't know. He said it was a millennial themed ETF. I don't know.
Yeah, it's the principal millennial. He didn't know. It's on Morningstar.
No, this is from our friends at Dimensional Funds, actually.
Oh, okay. Yeah, that's from that is an actual index or an ETF. It's a millennial ETF, not index.
How about Meme?
Meme stocks. That would be they buy like AMC and GameStop and wow.
How about LOCO?
Loco.
Loco. Apparently no. They have a crazy manager. It says. I don't know.
Okay, wait a minute. No. LOCO is the symbol for El Pollo Loco.
How about TIFF? TIFF.
Okay, that's either images or you're having a fight.
They bet on disagreements. And then my favorite.
You're making this up.
No, I'm not. These are all ones that shut down.
How do you bet on disagreements?
Who's going to win, right?
So you just go around, you go see a couple fighting, and you go, all right, here's $50 if this guy wins.
Not a couple. This is like companies, countries, that kind of thing.
Oh, okay.
And then my favorite, DONM, the DONM fund.
The Don McDonald Fund?
It's a no strategy. Because that's your word for the year, right? No.
Wait a minute. Was there a DONM fund?
No,
did you make that up?
I made that up. Sorry. And the Loco Fund.
You made up the Loco too? Because that's El Pollo Loco.
They're going to be really mad at me for writing them off.
Our credibility just went right out the window.
Please do not buy that on my recommendation.
We have been working so hard over the years
back up.
to build credibility, and Tom destroys it with one list of fake ETFs. We don't know the real ones from the fake ones now.
Yeah, we don't even. There's a thing called the interweb. You can go online and figure it out on your own. Won't be hard.
Wow.
So wait, you're telling me Loco? That's a stock ticker then? Okay,
that's a stock ticker. LOCO.
I'm feeling bad now
for El Pollo Loco, the chicken place.
Wasn't that on Breaking Bad or something?
No, that was Los Hermanos.
Oh, okay.
Los Pollos Los Hermanos. Yeah, I think it was Pollos Los Hermanos.
I think it was. Yeah. Chicken Man.
Well, we've ruined that story.
Sorry. No, I think it's still funny. I mean, but the bottom line remains the bottom line.
Oh, thank goodness. I was hoping there was actually a bottom line, that he wasn't just going to fool you all.
Here it is. Okay, please. People have looked at ETFs as kind of the new cool kid on the block, and they've invested in a lot of things like this because they think, that's kind of what an ETF is. No, that's not what an ETF is. They have some of those things, but an ETF is a similar vehicle to a mutual fund. It's, as Don said, it's a better invention, but it's not a place to go find something that's so cool, so wacky, you need to invest in it. You use the same style of ideas, structure that you had in mutual funds in ETFs. Index, right? low expense, and you're just more tax efficient in an ETF. You don't change any of that because you want to be cool using ETFs. Be cool because they're a better vehicle, not because they have these wacky, cute ideas of shorting or going long on Jim Cramer, for example. That's not the reason to invest in them. How's that? Is that better?
That's a much, much better discussion. And that leads us to the whole business of trying to buy what's hot. And by doing these, people are trying to buy what's hot.
Always.
Another way that investors, not really investors, I think speculators, are trying to find what's hot in the ETF market is they go back and they look at what was best in the past year. Well, I'm going to just buy the best ones. I'm going to buy the ones that went up. Well, they don't say it that way. They say, I want to buy the ones that are going up because we don't think of it as having gone up like it's done and not going to do it again.
Continuing, yes.
So what industry would you guess had the best performing ETFs in 23?
Well, I know the best performing asset was cocoa.
There are no, unless you're going to lie to people and say COCO, that's an ETF.
No, but I mean, cocoa was up 61%. Then it was the S&P.
What ETF?
Okay. Oh, the S&P information technology was next. I don't know what that.
Okay. Information technology was quite good. The iShares expanded. No, that's not the one I wanted. The Communication Service Select Sector Spider Fund.
Okay.
Or XLC was up 36%.
Sounds good.
The iShares expanded tech sector ETF.
Sure. Yeah, the 100 or something.
Gained 52%.
Wait, that's really, really good. That's a lot of money.
Really good.
So if you're thinking of running into that, it's a bad time, by the way. Yeah.
iShares expanded tech software sector. Getting more specific. Software. 55.22% in 1 year.
I wonder how much it could lose this year. It could lose that much and more this year.
It's funny.
Very
That's
narrow.
Generally, the way that stuff works. Yeah. That is generally the way that works. If it has made 55%, the odds of it continuing to make anywhere near that have declined precipitously because there's this little thing called reversion to the mean.
But our brain tells us this is what's happened. It's going to continue to happen. This recency bias that we all face.
And if we could find a way to overcome that and accept that we're going to very likely only end up with the returns of the market, all sectors, the good ones at some times and the bad ones at other times, overall, we would have all done quite well, probably better than most of us have done over the past many, many years.
Yeah. How much did you have in the Argentine peso last year? Because it had a bad year. Is the worst performing asset. It says down 78%.
Hold on. I want to find out the worst.
So I don't know that there's an exchange traded fund that allows you to buy the art. Probably is in today's world because they got so many silly, narrow,
many wacky things.
Dumb.
Let's see. The worst ETFs last year were all in energy.
Because it went way up the year before, and then it went way down last year. Sure.
Yeah. We had in natural gas, we had like 66% declines. Really, let's see, worst equity ETFs 2023. See, this is the problem. One of the ones that was worst in 2023, the market did really well. But the people who bet on VIX futures, the volatility index, lost 52%.
Wow. So volatility went down substantially
because the market went up. And
right, yeah. So things didn't bounce around as much, sure.
But energy did really, really badly. Social and environmental products did badly in 2023.
They're having a tough time right now, yeah.
Well, again, I think that comes back to the fact that it's so hard to define
what they are.
What is socially responsible? You asked that previous caller from the last hour, he would have told us something totally different than what I might have said. We're all different. 85, we know that, right? 855-935-TALK.
Tom and Don are talking real money. For your your real life and real future, Tom and Don are talking real money.
Welcome back to Talking Real Money. I'm Don, 855-935-TALK, 855-935-8255. That's an easy freezy call. Easy freezy.
No
it's
charge?
Easy breezy.
Toll free?
Toll free. Toll free.
Well.
855-935-8255. I would love, as would Tom, to spend a little time with you. So give us a call. And hold on, I just moved it.
What did you move?
The page I was looking at.
You were looking through the best and the worst of 2023.
Yeah. So I got that. But what I did is I got rid of my other page that was kind of important, where it had what we're talking about on the show.
By the way, do you know how this year has started for stocks? You don't, because you don't pay any attention.
I don't pay any attention, but I'm guessing not well.
Well, the S&P 500 is actually up 3%. But
really?
Global portfolio's down 0.7%. So, because other things haven't done as well.
Okay.
And then the intermediate term bond is down about 1% too. Intermediate term bond fund down 1%.
But we haven't even had a month yet.
I know. So I'm just putting it out there.
A month does not a year make.
No, it does not.
And you have to think long term. You do. We all have to. We really need, particularly if you're young. Oh my gosh, you need to think long term. And we actually had a call in the previous hour of the previous podcast from a guy who said he had two kids, 19 and 22, at home.
Yes, he did.
And totally jokingly, and then I thought better of it, but totally jokingly, I was going to say, well, kick them out. Send them out in the world, make them make a living, darn it. They're 19 and 22.
Come on, maybe at 35 or something.
No, I mean, at 18, I was out. It was like, you're 18, gone, go work, which I did from that point. Well, pretty much still right now.
Yeah. Right. Yeah.
Nonstop. But I was just joking. But the reality is, you as a parent of adult children, let's see if I can say this loud enough that my wife overhears.
Louder.
Yeah.
Mine too.
You as parents of adult children, I know you love them. I do. I love my kids. But providing financial help to them in anything but an absolute emergency could destroy your future at a time when you won't have anybody that you can go to for a handout if you end up with some surprises in retirement.
Yeah, I mean, you're talking about how to fund retirement if you're funding somebody else. And by the way, according to Bloomberg, it's half of young adults in the U.S. live at home. It says half. That's a very high number.
What do they define as young adults, though?
That's a good question here.
If it's a narrow, 18 to 25.
18 to 34, it says.
Well, that's a shockingly high number for a 15-year age group.
Yeah, U.S. parents spend $500 billion every year on their 18 to 34-year-old children.
Kids,
billion.
Go get a job. I don't like the jobs that are out there. No, there's anything
here's a
good.
Quote from a parenting coach says, for boomers, moving back home was seen as a failure. But now home means safety, not failure.
Oh, I would have never. I can tell you, I would have never run home in an emergency. I mean, it would have meant failure, that I was an abject failure. Yeah. Very different.
But here's what we see a lot is, because we look at a lot of retirement plans, is that people's retirement plans have to be put off or they have to live on less. As you correctly point out, Don, there is no grants or loans for retirement. It is what you got. It is a combination of Social Security, maybe two Social Security benefits, a pension if you're lucky, and then whatever you've saved to pay yourself. That's it. And if you've paid others instead of paying yourself, I'm talking about putting money away, then guess what? You're not going to be able to retire. You're going to retire differently. That's what we see on a regular basis. And that is troublesome. I mean, troubling.
It absolutely is. And I think we as parents need to be, well, two things. One, we need to be a little selfish. And two, we have to separate our love for our children from what is in their best interest, too. Because is it really in their best interest to protect them from, as Shakespeare called it, the slings and arrows of outrageous fortune? Bad stuff happens. And temporary is one thing. Longer term's another. We'll be right back. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
So apparently these days, a lot of baby boomer parents are supporting their millennial children in adulthood. And we fear, as do many others, that this is such a big number that it really could negatively impact many of these boomers' ability to retire comfortably and securely, because they've blown a bunch of money on kids who, if it's this many, you said, how many? Half?
Half. It says half of young adults in the United States live at home.
I got to tell you, though, my wife, here's the problem. If given the opportunity, my wife would have my daughter at 30 years old living in our house.
Yeah.
She would. She would enjoy it.
I think she would. I think you're right. She's social like that.
So what do we do?
I wish I had an answer. No, I mean, I think like anything else, when it gets to after college, a frank discussion needs to happen about actual resources. I think this is at the heart of it. If you think back, when you're a parent, you want to make sure your kid has everything, right? You never want to tell them no because of money, for example, right? Even though we can't do everything. We don't really want to tell them no anyway because I want my kid to love me. But at this point, I think it's at the end of whatever schooling it is, that people have to have a frank discussion with the others about money. And this is part of the problem generally.
Well, that's a hard discussion to have.
It is, but generally we don't discuss money anyway. I mean, I didn't in my family. It just didn't come up.
Crying starts.
I'm sorry for that.
Yes,
but again,
it does.
That's better.
I've had this talk with my daughter, and eventually crying starts.
It's like then I'm just going to break down because I can't deal with it, right? I mean, this is a problem. And you're right. That's not a great place to end. But if you don't have these discussions, and half of American young people end up living at home, and baby boomers who may think that they'd like to enable that behavior because they love their kids do it, and find out at age 70, well, now I can't retire because I don't have the money, then what? That's far worse. That is far, far worse than somebody facing difficulties at 25. Because at 70, there's no way to fix it. At 25, you still can.
Do you think, though, part of the problem is us and the way we raised our kids?
Oh, absolutely.
That we, sure. I mean, I know that particularly my youngest, she had everything.
Yeah.
And so in adulthood, when she doesn't make as much as dad makes, she can't afford everything. And I think sometimes that's a very difficult transition.
I agree. Yeah. We've talked about this ad nauseum, but because this has happened in my family as well. But the point is, do it earlier instead of later, because what happens is when you sort of enable, okay, we'll take care of this. At some point that day will come where you and Debbie can't afford to do this for your youngest. At some point it'll come in my family where we won't be able to afford it for my stepdaughter who just can't do it anymore. It's better to do that early than late, because later, the more this goes on, the harder it's going to be to fix. That's my take.
Well, I have really great hope on my end, because my
your
daughter,
sharp. Yeah.
She's in grad school. She decided to go to grad school at NYU, which is very expensive. Dad, but she's also working, and she's gotten a very, very good job with a big nonprofit. So she has a great future ahead of her. So my hope is that she's just going to, and maybe that is the thing, is that your kids will take themselves off that track eventually. And
I think what you mentioned, the conversation happened and they're crying. Maybe you don't fix
when
it
she was
right
much
then.
younger. Yeah,
yeah, but that doesn't fix it that day. But it does say, this is it does make people think, oh, you know what? I gotta think this through, because I don't want to do this to mom and dad. I don't want them to end up in a bad place. I don't want them stuck in the silver bullet outside Tom's house. That would be horrible.
I'd be perfectly happy out in the silver bullet. It's got memory foam beds and
You're all air conditioning.
it's air conditioned and I got internet and a stove and a refrigerator.
Right, you're all set then. Yeah,
brand new
good.
shower.
There's a pizza oven right next to it too.
Pizza oven. Can I just can I make pizza right
Every
outside
night.
the?
Yeah.
I am gonna be making pizza, boys and girls. Ho ho ho!
We'll give out the address.
Give
You
me
can come
that.
over.
Give me that wood-fired pizza.
Yeah, it's pretty good.
Tell Dee Dee just to make up a bunch of crusts. I'm good from there.
Ready to slap on whatever you got.
Yeah, give me a bunch of and a pile of wood. I just need a wood pile.
There you go. You know how to make
Anybody
a
want to
fire.
bring a wood pile over to Tom's? You got a tree you took down, bring it on by. Better if it's
gotta
an
be
apple.
It's gotta be
I was
apple.
going to say, better if it's an apple.
Yeah,
you
it's
know,
gotta be.
I guess
not the computer, but yeah.
a hickory would be okay. You know, nice hardwood with a little smoky flavor. 855-935-TALK is our phone number, 855-935-8255. Look at that. No Christmas lights on the phones. Kind of sad.
Come on, call him.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Oh, this is great. I just got a text from my daughter. Speaking of my daughter, who's in New York, and she just sent a text saying, casually stumbled upon the curling national championship.
Oh.
She's watching the Can-Am Wheelchair Cup.
Wait, wheelchair people, they can do disabled curling?
Yeah, they're curling
Wow.
out. They're in wheelchairs. That's pretty amazing. And then
That
she
is
said,
amazing. Wow.
she goes, then we're going indoor snowboarding after. Where in the world would you there must be a place in New York where you indoor snowboard.
I think I've heard of those places. Yeah, I think they exist. That's cool.
We need one of those in Florida. Now, that
Yeah.
would be awesome. Build one, somebody. Anyway, 855-935-TALK is our number, 855-935-8255. Don here, Tom there. Do you have a question?
Yeah, I do. I do, actually. This comes from
Is
Bruce.
this really long?
I read through it to try to abbreviate it a bit. This comes from Bruce in Lola, Kansas.
Lola.
I don't know. I never heard of it, but that doesn't mean anything. I have a question about fixed income in my taxable account. Fixed income are bonds, right? Fixed income.
Fixed income or CDs.
Yeah. I've inherited $450,000 from a living trust that was managed by a bank financial advisor. Mm-hmm. Investments are a hodgepodge, 20% equities, 80% bonds, mostly municipal bonds. Also inherited $80,000 in an IRA. Okay, so we got $450 there, then $80, and our net worth before this was $230,000.
Well, their net worth just doubled.
Yeah, well, more than double.
More than double.
$450 plus $80 is $530 plus, et cetera. Went up a lot. My question pertains,
tripled. Tripled.
My question pertains to maintaining my mix of 55 to 60% in stocks and 40% in bonds, even though most of my money will now be in a brokerage account. And he goes into sort of how that could all happen, but that doesn't matter to me. What matters to me is how if you took all that money, right, the 450 plus
now,
the 80
I hope he's
plus
talking
the
about
230.
a discount brokerage like a Schwab or.
Well, no,
Fidelity.
right now it's still the bank. I think he's going to move it.
Got it. Okay.
Yeah.
I just don't want him to move it to Morgan Stanley or.
No, and let's just say,
Lynch.
for sake of argument, it's 700,000 total, right? And you want to be 60% in bonds. I mean, 60% in stocks.
Mm-hmm.
That sounds like 420,000 to me. Correct?
Good math.
So here's the way I would do it. There's a couple of easy things to do. First of all, the 80,000 in the IRA, that would be all fixed income. Right?
To avoid paying taxes.
Right, because then you have the fixed income there. Mm-hmm. Then, now
and it would not be municipals.
Well, yeah, I'm just getting to that because he says he's in municipals. That depends on your income. You got to have a pretty high income and need to be a fairly high tax bracket.
Is he retired or is he working? Does it say?
It doesn't say. Does not say.
Okay. Because if he's not working and that's all the assets he had, then he's not likely to be in a very high tax bracket.
That was what my thought
therefore
was.
Not needing municipals.
Yeah,
if
exactly.
he has a high income job, and by high income, I'm talking in the mid six figures.
Well, he says later on, my income now and in retirement will not justify municipal bonds. Good for you for figuring that
good.
out. Okay,
all right.
So, but the 80 to me would be that. There's a start. That would be all in like BND or something like that, a total bond of some kind. Or if you were, you could get a little fancier there. You could have an intermediate term if you wanted to have a little tiny bit of long. You could get fancier with that, but that would be the start. Then you take the other 620, right? And you're gonna have to own some fixed income in that taxable account. That's not a big deal though. If you're in a low tax bracket, that's not going to matter that much. Mm-mm. So you're simply then going to divide what's left in that inherited trust account and your other 230, which does not spell out whether that's qualified or non-qualified. You're simply going to divide that up between stocks and bonds to equal the 60-40.
Yeah, and then in the stock side, you want to have about half of that U.S. and half international.
Yeah, right, and big and small, and
then you want some
growth.
Big and small, but more small. You want value, more value.
Yeah,
but. You want to do that through ETFs because they do have tax advantages.
Because your net worth was $230,000 and you just came into $530,000. And I hate to say this because it sounds promotional, but you're in a great spot to at least get some advisory help.
Yep, that's where
it's a major life change. You don't want to make a mistake.
This is the point in life where you start to need advice, ongoing advisory advice from a fiduciary advisor, whomever that might be.
Yeah, I mean, we're not the only people. There's lots of them out there.
No, we are definitely not the only people.
So that would be and you can go, I think, to talkingrealmoney.com and click on
Meet an advisor. Or help /help.
Shows you other places.
Yeah.
But that would be a start. I mean, but going back, Bruce, before I did that, we talk a lot about this. I would at least have a plan as to how much money I need to make, how much income I need from this before I just said sort of unilaterally, I want a portfolio of 60% stocks, 40% bonds, because I don't know that about you. You may not know that. You need to make that determinant first, then build the correct portfolio, not the other way around. That's what a good advisor should do for you.
That's what a good advisor would do for you.
Yeah. Yeah.
If they don't talk about a plan, very first thing.
Just met somebody today that is this week, substantial assets and invested, but no plan.
See, that's irresponsible.
Doesn't make any sense. I agree.
How can you invest if you don't know what you should be investing in?
Or what you're investing for.
Yeah, and what you're investing for. And how you comfortably invest. What's your personal profile?
Yeah. So, and you could take the risk quiz too, by the way, would be a good idea.
Yeah, that's a great thing to take.
Mm-hmm. Yeah.
In the past couple of weeks, we've gotten some questions and calls from a lot of people about something that I said on previous shows. It was after I read this article. I went back and found it from
I know
the Wall
what this is about because I got another one about it this week.
Yeah, from the Wall Street Journal.
Yeah.
It was an article about people giving up homeowners insurance on their homes.
Yep.
And it focused, and this is all anecdotal, but in Florida, I'm in Florida, I can tell you that this is a problem.
It's expensive. If you can get it.
Well, listen to this number. This is a guy who lives in a neighborhood near West Palm Beach, Florida, an older neighborhood with smaller houses, all of which are worth in the millions because it's Florida now.
Yeah, right.
They got their new bill last year for their homeowners insurance on their $3 million home.
And?
$121,000 a year.
Wow.
Okay? There's an insurance agent in that same community. He said the highest insurance premium he saw last year for a multi-million-dollar home was $600,000 a year.
You guys are expecting bad weather again or something?
We always have bad weather.
Wow, that's really something.
We're gonna somewhere in Florida is gonna get hit by a hurricane every year probably. But what is fascinating is this couple, they talked to their other neighbors, and their neighbors, they said everyone they talked to, if their house was paid for, they were dropping homeowners insurance.
So, I mean, here's the thing, though.
They did not believe it was worthwhile.
If you did that,
right,
and you're wiped out, and you don't have the assets to either rebuild or do something else, then what?
Here's the thing. When you look at the statistics, we don't have, unless you're right on the coast in Florida, these houses have survived, many of them 150 years. they're not going to get wiped out. What
You're
they're saying,
you're going to guarantee that?
No, they're not. But it's what is it? A 1 in a million chance
That's
your house is going to get leveled?
Is. That's
But $121,000 a year.
That's crazy. Wow.
You've got to figure out whether the cost justifies the protection. That has to come into the equation these days.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I mean, get this about the insurance issue. The mayor of Palm Beach County dropped his insurance completely when it went to $20,000 a year. This other couple said...
How much is his home worth?
I don't know. It didn't say.
Oh,
okay. This other couple they interviewed about it said they have a 1,000 square foot house, $10,000 a year in insurance on it. They said if our house gets blown down, we will sell the land and move.
Yeah, I mean, it's like all insurance, right? It is truly you can make an argument for it, you can make it against it. There's not one right argument. But there
reaches a point though where the cost benefit analysis gets, because I know I've been through now 3 major hurricanes that have crossed literally right over the top of my house. I have sustained maybe $100 in damage, didn't file a claim. Now that's 26 years later, and yet I've been paying thousands and thousands and thousands and thousands of dollars a year. Mm-hmm. So
how much is yours now a year?
Think.
How much is yours?
Oh, mine's only about 5 because I'm inland.
Yeah, okay.
But that's still high.
Yeah, it's.
And the reality is, I can see why people would do it if their house is paid off. I mean, if my house was paid off and I could go without that, say I got up to $10,000, I would not have a problem cleaning up after my blown down house, using my other assets and building a much smaller house on the same land.
I think that makes sense anyway. All right, we're just about out of time, but we do want to invite you out to see us on February 24th in Bellevue for the 10th annual Retire Meet. It's going to be fun. Herb Weisbaum, Paul Merriman, Don's coming. I'm coming. Yes, we're all going to be there. So basically a full day of education about all the things you need to know about in retirement. So it's fun. It's educational. We'll be doing the show from there as well. And it includes breakfast and lunch for those who focused on food. So you can.
What about dinner?
You know, I never thought about that. You mentioned something about the after party last time. I don't think we should go there again.
I enjoyed the after party.
Okay, so I figured you did. So anyway, you can go get a ticket now, and they're going to go fast. We're already more than 2/3 of the way sold out, more like 5, 6 or something, a lot. So go get a ticket at retiremeet.com.
Look at you, Mr. Fraction Guy.
I know. Well, okay.
So
2/3.
So is it comfortable now for you that it is?
Yeah, it is. It's a month away, and we have most of it sold. So yes, I feel
all right. And it is, by the way, it really is. This is the reason we've now done it. This will be 10 years doing this. It really is a fun event. I mean, even though we were probably the cause of the COVID pandemic in 2019.
Didn't we did it in February 2020.
Was that?
And then
oh yeah, that's right.
Out.
February 2020.
Yeah, we literally did.
Literally the first guy in the country was in Seattle.
It was.
We brought 400 people together, and then we all took it around the country as we headed home.
Ouch.
No, it really is a tremendous event. It's so nice to see everybody. It's a gathering.
It is.
And there's so much information shared, and everybody's so friendly. Everyone will sit down and actually one-on-one with you.
I know.
Jim Zorn. Did he Jim Zorn?
Not available this year. Couldn't get him. I tried. Really worked hard, but okay.
Well, we have good people. Oh, and I love Weston Wellington's presentation.
He's the best. Yeah.
I do love Weston.
Yeah.
Paul Merriman.
Good folks, yeah.
I love Paul. Who else do I like? Tom Cox, like him.
Medicare.
Oh, Kevin Peterson. Oh my gosh,
Always
his Medicare help so good. I am going to use him when I finally decide to wrap this thing up. So go to retiremeet.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.